Good morning, everyone. Once again, it's a lovely Tuesday morning, and I'm coming to you live from inside my house. We are still on lockdown, and we're all doing well. If I can quickly see there who's currently watching, so that I can see how everyone is doing. And yeah, today we're going to discuss structured products, and I've got a very nice lineup. We call it alternative investment. But before we get to that, I just quickly wanted to answer a question that we had last week regarding the tax-free accounts and paying dividend withholding tax if you are exposed to foreign dividends. So yes, we are paying dividend withholding tax if there are any dividends declared within the exposure that you've got to a foreign company, but everything locally based, you will not be paying tax at all. So just on that note, last week I said I will get back to you guys. So yes, on foreign exposure, if dividends are declared, you will be paying dividend withholding tax. It pays within the investment, and I'm also busy doing research to see when last Harbour Wealth model actually uh, declared a foreign dividend and how it affected you. All right. So to get into structured products, and first of all, I thought it would be good to maybe read one or two definitions that I had to Google because we all have an understanding exactly of how these investments work. But I thought it might be nice to maybe get a definition on Google. And what I could get up with is a structured product are pre-packaged investments that normally include assets linked to interest plus one or more derivatives. So that is the one that I could put together. And then another one, it's maybe in more simple terms, is a structured product is essentially a contract between the investor and the issuing bank, with the latter promising to deliver the guarantees and geared returns as promised in the contract. So, a little bit more on that later on, especially when we go into but how does a structured product work? But first of all, I wanted to discuss why would one consider a structured product? Now, first of all, in volatile times that we're currently experiencing, and I mean, we woke up this morning or saw last night that the US, and I don't know how many of you have actually seen it, but the US is currently paying people to come and collect barrels of oil. So that is extremely interesting. The times that we are in is extremely volatile. So one of the things that people tend to run towards during volatile times is structured products. And the reason for that is that people would like to preserve their capital, but also they want decent returns. And the more I look into structured products, I laughed at it and I thought, you know what, the guy that maybe started a structured product was one of those that thought or actually heard from a lot of investment clients that, you know what, we want the highest returns with the least amount of risk in the shortest period. So normally, then that's one of those catch 22 that one sits with is I really have to give you high returns with a guarantee that you can't lose your money and also in the shortest space of time. And I think maybe that's how structured products then eventually evolve. No, that's tongue in cheek. All right. So first of all, in volatile times, people tend to know what. Let's go into an investment where we know exactly what we are going to achieve. All right. Then the next step, uh, diversification. So if you look at your whole investment portfolio, now you've probably started a discretionary investment, and that is your 2 to 5 year plan, maybe, or your 12-month plan. You've started your retirement annuity so that you can one day retire, and then also your tax-free investment, and you've got a whole range of different investment vehicles. So one of the means of to diversify is to now look into a structured product. Okay, because you get specific returns at a geared rating over a specific period with the least amount of risk. At the end of this program, also, I'm going to touch on two unique structured products that's currently in the market, and then you will also understand when I talk about the upside and the guarantees that one can have. Then another reason why people tend to go into structured products is because they want transparency. if you're not a very risk averse client and upfront you would like to know what are the fees that I'm paying or the costs involved, would like to know exactly what my return is going to be. And then the last one also, what is the tax going to be on my investment? Then transparency is also one of the reasons why one would go into a structured product. Okay. Then foreign currency exposure. So once again, a lot of people go, you know what, I might not have enough money at this stage, or I'm a little bit scared to go direct offshore. Then they tend to go into structured products because they know they can get unlimited exposure to offshore currency. And by the way, some of the structured products also have it will either pay out in rands or it's going to be in dollars or in a specific currency where the note is lying. And then the issuer, so the bank or the issuer of the structured product might be in rands or in dollar. So on that note, you want foreign exposure, but you don't want to maybe go direct offshore or all of that combining together with the safety that you've got, the guarantees that you have. And once again, in volatile markets, to have offshore exposure, knowing that you cannot lose your money, sometimes is a win for some clients. On that note, I just want to mention and reiterate that structured products are not for everyone, and we're going to get to that as well. But it's important to understand that it needs to fit in with the plan and the investment strategy that you have and that you have discussed with either myself or with your financial advisor. Okay, then so the next step, if we look into structured products, the big question is how does this work? But before I get to that, I'm just going to have a sip of my coffee before that gets cold. And then if anyone would like to send me a question, please, the chat is live. I am available on my emails as well as on WhatsApp, as previously mentioned. I'm always open to any questions. So I'm just going to have a sip of my coffee and then we're going to have a look at what has come in. Anyone that would like to ask a question before we carry on to how a structured product is put together. Okay. Right. So in today's comments afterwards, I am going to be posting a video which Eugene Marais, one of our colleagues at Harbour Wealth, has made a very nice, let's call it an infographic with an explanation exactly of how structured products work. But to put it into simple terms, so because I mean, if we discuss now the investments, how the structured product is put together, and the returns that one can get, specifically in South Africa, people go, yeah, but if it sounds too good to be true, then it normally is. So to just give you a snippet of that is if I tell you that you're going to give me your money and half of that is going to be invested into a certain portion, and after 3 years, you're going to get a return of above 10%. And by the way, the other half, I'm going to have 100% full exposure into an offshore equity market and I'm guaranteeing 100% of your capital. That's the type of thing that I'm talking about where people go, oh, maybe it sounds too good to be true. Okay, so how does it work? So in simple terms, is you as the client come and give us your money. So what we as a company do and the issue of the structured product do, the two that I'm going to mention later on also is based on Wealthport's platform, and the guarantee is issued then by ABSA, is we go to them and we ask them that if we give you a certain amount at, in let's say in 5 years from now, how much do we have to give you now so that we can guarantee exactly that amount again in 5 years from now? So the example is we give you 1,000 rand. So how much do we, of that 1,000 rand of the client that he has given us, how much do we have to now give you so that in 5 years from now you will give us our 1,000 rand back? So what happens then is the bank or the issue of the note says, okay, we want 700 rand. So 700 rand of your 1,000 is going to go towards the one leg, and after 5 years, you will get 1,000 rand back. So then we say, okay, brilliant, we're happy with that. But the good thing then is we've got 300 Rand of your money left. So what do we do with that 300 Rand? So we go and we buy an option. So with your other 300 Rand, the option, and let's say we buy the all share index. So we go in and we buy the all share index, knowing that once again, we ask that if we can buy that option in 5 years from now, how can we guarantee that we're going to have the 1,000 Rand again? Okay, so then once again, they tell us this is what you're buying into, this is the index rate that you're getting into, and then how we guarantee the capital is, because remember, we've already used your 700 Rand to guarantee you the 1,000. So now you've bought in at a certain level. The market rises. At the end of your 5 year, there it's grown to 1,500 Rand. So the good thing is you as the client can get the 1,500 Rand. On the other side, if the market is fallen down, your capital is already 100% guaranteed, because and it's basically, see it as two options. You've bought on the one side, we've taken 700 Rand of your 1,000 Rand, and we've bought a guarantee that after 5 years from now, you will get your 1,000 Rand back. With the 300 Rand that we had spare, we bought an option, and therefore all fees and costs that you do pay is already within the product. So once again, if you come and give us R1 million, your full R1 million will be invested. There's no, we're going to deduct this and we're going to deduct that. I know a lot of the companies out there give you a boost up front, but eventually then the boost gets deducted in a certain way. You might lose certain ways if you don't stick to the rules. A structured product does not work like that. You get full exposure from day one, as well as it is taxed within the vehicle. It depends also on certain structured products, how it's put together. So it's very, very important to understand the rules and how it is put together, because there are a lot of structured products out there, and we're only going to touch on two today. Right, so before I carry on with that, any other questions that someone might have regarding how a structured product works and how you can actually get your money back? Just want to quickly run through here. Right. Let's quickly see anyone that would want to have a go at the live chat. I think it's very simple and self-explanatory at this moment. So the chances are good that everyone gets it clear and how it works. Okay, so the next part that I want to go into is, when is a structured product actually going to be suitable for you? Now, the first of all, you need to be able to give 100,000 Rand. So the minimum of most structured products is 100,000 Rand. Okay, so that's to be able to make it worthwhile for yourself as well as for the company that is doing the investment on your behalf. Then the second thing is, you don't have to have liquidity. So this is actually more of a when and things to keep in mind. If you need liquidity within your investment, then a structured product is not for you, because you have to be fully invested for the full term that the contract is between you and the issuer of the contract. Okay, so like I've mentioned in the beginning, between yourself and the bank within one of the definitions. And the other thing is, when you want a guarantee, one of the risks that one currently sits with is, even though you're buying in an index, and let's take the specific time that we are in today, is where markets are extremely low, it's extremely volatile, it's bouncing up and down the whole time. And we don't know exactly how this is going to plan out within the next 5 years. Let's take history. I mean, the last time these type of returns or market crashes has happened, the next 1 or 2 years after that, the market has bounced back extremely. So therefore, once again, the structured product that you go into, you need to go and see, do you have an enhanced return that's maybe capped? And that's one of the structured products that we're going to touch on later on. Or is it open-ended? Because now some people might say, you know what, I would rather understanding the investment market, I would rather go into a normal discretionary investment because I feel within the next 5 years, the markets are going to have a very good run, and then I don't want to be limited. The same on the one leg where you get your guarantee. If you don't want to be limited to a specific guarantee, then a structured product is also not going to be for you at all. Okay, so I think I've touched on the most um, parts of a structured product and how it can actually work for you as a client. So therefore, I think it would be important to quickly go into the two different structured products that we've currently got running, and then I'm going to just mention another option that comes up frequently, so that you can just see the difference in how these things are structured. Any questions? Anyone that would want to add anything? Let me quickly go here on WhatsApp. Anyone on the chat? By the way, just give me a thumbs up there on the chat so that I can just know who I'm talking to, or just wave. It's always nice to know who your audience is. Okay. Right, so we've got one of our regulars, JP, asking a question here. The 100,000 Rand, can we group it together? So can people put money together to go into a structured product? JP, yes, I assume you guys could probably do it. Remember, at the end of the day, you will not be able to do the investment in 5 different people's names. You're going to have one guy that basically stands par for everything, and it's going to be on his name. And therefore, he's going to be held accountable for whatever happens within that. But in the background, if you as a family or you and your wife would want to pool money together, then yes, definitely, you will be able to go into a structured product. But just the emphasis on it's still going to be in an individual's name. So I hope that answers your question. Then right, so one of our colleagues at Harbour also just mentioned something here that I want to mention to you guys is when is your structured product and the environment that one finds yourself in, when is it actually going to be the best for you to go into? When interest rates are high, there's high volatility, as well as markets that may be expensive and more risky. So back to, I want guarantees, I want transparency, I want to know exactly what I'm going into. And I would say this is actually your more conservative investor would find a structured product way more appealing than what your aggressive investor would find, and your chance takers out there, and stockbrokers, let's call it that. All right, brilliant. JP, you happy? Okay. Hi there, Tienes. All the way from the Netherlands again. Thank you very much for tuning in. Appreciate that you're taking your time. And guys, just on that note, coming up now, that the reason why I'm doing this, I think in a time like this, is more also to educate. I think it's important that people are more educated when it comes to their investments. And then I challenge everyone who is watching that they would actually go and study, read further. We as wealth managers, we've got the ins and the outs, and in the back office, we guide your money and we can steer it towards what we want to achieve, and ultimately get to what you want to achieve and your goal. But I think it's important for us to have more, let's call it structured conversations. I think it's important that every person out there make sure that they know exactly what they're going into, read up on your own investments, and get knowledgeable. So let's carry on. The two structured products that we currently have available. So the one is called the SA Fixed Return and Global Growth Protector. Now, this is a 3-5-year product. So it's a 3-year and a 5-year product. So how this thing works is we take your 100,000 Rand, 50% of that. So in this, it's an easy calculation. 50,000 Rand of your money will be going into the 3-year leg. Now, the 3-year leg is exactly in 3 years from now. And by the way, if you go into a structured product, there will be a specific investment date. So let's say, for argument's sake, it was on today, the 21st of April. Exactly 3 years from now, your 3-year leg will pay out. And this specific one, the SA Fixed Return and Global Growth Protector, is giving you currently on half of your money 10.07% simple interest. If you multiply that by 3, half of your money, you will get 30.21% simple interest. Now, the argument quickly comes up is, yeah, but it's simple interest, it's not compounded. The one thing and the factor that you need to keep in mind, this is after cost, after tax. So in a time like this, getting more than 10% fixed, guaranteed, that's what you'll be walking away within your investment. I think that that's really not bad. And then these things fluctuate the whole time as we go along. So please be on the lookout. I think this is the 30th or the 31st edition of this specific structured product, and it keeps on rolling over. So it would be interested to see what the next one is going to be. Then let's go into the 5-year leg. Now, the 5-year leg is almost where I could say the magic comes in, where 100% of your capital is guaranteed, so you cannot lose your money, and it is exposed, and the fund that it's going into is the Credit Suisse GEM 10% risk control. So that's now where you are exposed to global equities, the US, the Europe, and there's almost 145 to 155 stocks that, or the equity component includes about 145 to 155 stocks. So to think about that, you going into a product for the next 5 years, you've got unlimited upside exposure within a product where you cannot lose your capital at all. I would say that that is a win. Now, some of the questions that people might have is, okay, but what is the risk? Back to what I said, this sounds almost too good to be true. The risk that you're sitting with is the tax within the 5-year leg, up to 75% growth. You won't be paying tax because that's already within the vehicle. On top of that, then you will be liable for the tax. But 75% over a 5-year term, that is decent growth. We always tongue in cheek say, if you've received that type of growth, then someone would almost happily pay the tax on that investment. So that's the one side. And then another thing to just be aware of is the exchange rate. Now, I'm quickly going to focus on the exchange rate and not going into too much detail. If you would want me to go into detail, please send me an email, send me a WhatsApp, and tell me, listen, Volker, I would love to have an in-depth discussion on this. But the important thing to understand there is, let's say you're going in at 18 Rand, what it is currently at this moment. And exactly 5 years from now, the Rand has strengthened down to 16.50 or 17 Rand. Then there is a calculation that needed to be taken into account to offset that. But in your 100,000 Rand terms, you will never get less than that out. Okay, but like I said, we can have a more in-depth discussion to show you exactly the calculation of how it can impact your growth. On the upside, and maybe some people see it as a risk as well, let's say your investment anniversary comes up, it's close to that. If the market has increased, so that specific index, you went in at a specific price, all of the upside growth is yours. The only problem that you can sit with on the anniversary date, you have to withdraw your money. Let's take 2 months back. If someone was in a normal investment, like the majority of my clients are currently, is the market has collapsed. So what do we do now? We say, you know what, let's wait it out for another 3, 4, 5, 6 months so that this thing can just pick its head back up to where we originally were, and then we can actually withdraw our funds. Whereas close to your anniversary, if the market has collapsed by 20 or 30%, then actually you're just going to get your funds back. So you can see that as a negative, but I think at this point there's so many positives within a structured product that it outweighs the negatives by far. All right. So the next one is a market first that we at Harbor Wealth, as well as the platform Wealthport that we're making use of, is extremely excited about. But before I go into that, I just quickly want to check. There is WhatsApps coming in. Okay. Let's quickly check. Is there anyone maybe on the chat that would want to ask something on the specific structured product that we just discussed? Oh, my coffee is completely cold. Okay, let's have a look. Okay, so like I said, the next one, excited because it's a market first, a structured product within a living annuity. Now, quickly recap, what is a living annuity? Once you've got a retirement annuity and now you decided, you know what, I'm going to retire from this, you go into a living annuity where the living annuity pays you a monthly income. And you're allowed to choose between 2.5% and 17.5% of your fund value that's available per annum, and that will be paid out to you monthly. Now, Wealthport, together with ABSA, is throwing in a structured product within a living annuity. So please, I want you all to get the message out there. This is an extremely unique product that is a market first, like I said, and it has never been seen. So please, if you've got people, your parents, Opa, Oma, grandparents, anyone out there that's currently sitting with a living annuity, they need to explore this specifically within the times that we are in. So this one is called Global Defined Returns Retirement Protector. Now, the previous one had a 3 and a 5-year leg. This one has a 1, 3, and 5-year leg. So first of all, the minimum amount that one can put into this structured product is 500,000, and that 500,000 needs to be 25% of your investment. So you need to have at least 2 million and above within an existing living annuity so that you will be able to make use of this specific structured product. Now, on the 500,000, 25% of that goes into the 1-year leg, where you will get a guaranteed interest of 18.8%. And yes, that is not a mistake. On 25% of your money, you will get 18.8% guaranteed return after 1 year. Then the 3-year leg, another 25% of your money goes into that. There you will be earning 38.8% simple interest on that portion, which is once again an amazing guarantee. I mean, to think in times like this, someone is going to tell you, you know what, give me your money now, and I'll be giving you 18.8% in 1 year from now and 38.8% in 3 years from now. That is extremely amazing. That's after fees, after tax, after everything. And then the last leg, so 50% of your money then goes into the market exposure, exactly like the 5-year leg on the previous product. So it's got full on market exposure where you are exposed to equities. And the fund or the index that it's going into is the Credit Suisse Global Equity Multi-Factor 10% risk control. So that is the one that you will have exposure to. But here there's a little bit of a difference, is you get an enhanced return. So what does that mean? If the market has grown by a specific percentage, so you go and take the index, on the date that you go in, exactly 5 years later, the index has only grown by 10%. Then the enhanced return will give you 20% on top of your money. This one, however, as previously mentioned, is capped. You will only get an upside maximum of 50% of your money back or growth, which is once again within these times not a bad type of return or guarantee that you can get depending on how the index has performed. The only risk that you're sitting with is the index might be low at this moment, so therefore within the next 5 years it might outgrow the 50%, and then you as a client might feel that, you know what, maybe I've lost out. But then remember again, on 25% of your money, you received an 18.8%, and on the other 25, 38.8% simple interest. So yeah, those are the two unique structured products that we've got currently running. Just another option that I quickly want to mention is we had an auto call lately from Investec, and the moment that comes up again and is available, then we will let you know about it. But please, if things like structured products interest you at this moment, please make contact so that we can always keep you up to date with what's happening. But just quickly on an auto call, how that one is structured is you give your money once again, and then you go in at a specific rate. But what it does then is after 3 years, so for the first 3 years, you are locked in. But then they will give you, let's say the rate that you're giving you is 10%. So what they do is after exactly 3 years, if the market is flat or just a little bit up, the investment, they call it, it calls. So that's why it's called also an auto call. And you will get 3 times 10%. So you will get 30% on your investment. Let's say exactly 3 years from now, your investment is actually below the index level, then it just rolls over to the fourth year. On the fourth anniversary, if it's the market is flat or just gone up slightly a little bit, then you will get your 10 times for your 40% return. And then after 5 years, if it's never ever called on any anniversary, then you just get your money back. But there's also fine detail within how much can the market fall within this specific auto call. If the market is down by more than 30% on that exact anniversary date, then unfortunately the client takes the full loss. So that's also an option out there. That's also how structured products can be put together. So this I would recommend for someone that's more experienced, someone that's got a little bit more knowledge and is a more risky, because at the end of the day there is a chance that you can lose some of your money and actually take a real loss. Right. Hello there, Yolanda. Also one of the regulars. Thank you for joining us and tuning in. I appreciate that you've come in and said hi, or maybe it's a goodbye. And I hope you've enjoyed it. Yeah, everyone. Yeah, that's a wrap basically for today. I think I've touched on everything that we need to discuss regarding structured products. While I'm saying goodbye, I'm going to have one last look at the WhatsApps. There's no questions coming in there. Anyone that would want to ask a final question before I quickly recap and just give a summary on structured products. Okay, so let's quickly recap. A structured product, what is that? It is basically a contract that you and a specific issuer go into, where you've got certain guarantees, you've got certain geared returns, and you know that in a specific date or on a specific time, you will get what the contract says, depending on if the market has done what the contract says. Who needs to go into these investments? People that, first of all, they want transparency. They're very risk averse, so they don't like the volatility that's currently going on. They want to know exactly what's going to happen. They're not sure about the tax and the fees that they are paying on other investments. And therefore, in a volatile time like now, you would rather want to know exactly what you're getting yourself into, as well as then diversification, to take your current portfolio and diversify it into a different alternative investment. I just want to put emphasis once again, it is important to know exactly what the rules of the structured product is before you go into it. I would like to thank everyone for joining me once again. Next week, Tuesday, please tune in again. I will let you know the topic that we're going to discuss. If there's anyone that would want to send us topics that you want to know more of, we can put a poll out there as well to see the interest. Next week, I think, is going to be more risk, where we're going to go into the financial planning, the life cover, disability, and those sections. I think there's a lot, especially in times like these, that needs to be discussed on that section as well. So until next time, guys, please be safe, stay in your houses. We hope we're going to get a very nice message from our president. We're going to slowly but surely start opening up so that the economy can start getting a boost again. Until next time, thank you and bye-bye.